Thank you for joining me for a look at what could be a significant problem for the stock market, and that's the fact that there's just too many bulls. Now, bull markets historically climb a wall of worry, and worried investors are truly a sign of potential market gains. See, if you're worried, you're not fully invested. As your worries decrease, as you stop fearing a potential pullback, you become more and more invested in the stock market. So, as your worries decrease, as the number of bulls increases, in other words, we move off of the sidelines and there's more cash at work in the market. In simple terms, it's cash buying that moves markets up. It's raising cash or selling that moves markets down. So when we look at sentiment indicators, what we're measuring is potential cash and how it's working out in the market. If there's a lot of bulls, it means there's not a lot of cash on the sidelines. When there's a lot of bears, it means there is a lot of cash on the sidelines, and that could potentially fuel a market increase. Now, we measure a lot of these things with sentiment surveys, and the oldest continuous survey is done by a firm called Investors Intelligence. They look at the market sentiment of professionals, and they do it in a subjective way. They don't ask the professionals what they think. They analyze their writings and make a determination. This requires continuity in editors, and they seem to have a pretty good process, even though it is subjective. Now, tops come weeks or months after bullishness peaks, and that's to be expected. As the number of bulls increases, money moves into the market. Eventually, all the money's in the market, so to speak. That doesn't mean markets are going to immediately fall. It means markets are going to top. So what we saw in late last year or early this year, the blue line represents the number of bulls, and we'll look at this in a cleaner way in the next slide. But the number of bulls became high, higher than it had been, in fact, since 1986. So something was different about this market, and bulls were rushing in. Now, a cleaner way to look at this is with the bull to bear ratio. And as you see, we're still at a rather elevated level, but falling. And we hit this high here, the highest level again since 1986. This chart shows the market action after we hit that high of a ratio. And as you see, the bull market in the 90s truly climbed that proverbial wall of worry. Now, even as market was falling in 2000, investors still weren't worried enough. We're still worrying about further declines. They were acting exactly as you would expect them to act. It's these isolated periods where we see a surge in bullishness that we see a pullback. The question is, was this enough of a pullback? The indicator seemed to break down here over this bull market, but the sentiment did become extreme before what in effect was a bear market here in 2015. The market went sideways for almost 2 years. That's a bear market. Now we have pulled back about 10%. The question is, could we pull back more? Well, with little cash on the sidelines, that's definitely possible. On the flip side, when this indicator falls below 1.0, we do tend to see rallies. So extremes also mark important bottoms. Where we are now is the highest since 1986. The peak was seen in November. Now, what happens as we see this market indicator top, that means money is in at a high level. Once prices fall about 10%, as they have, stops are being hit and selling is increasing. That should accelerate the downside. There's a really logical flow as to why this indicator works. And the logic tells us we have a warning sign the market is technically weak and we could see significantly lower prices before we get new highs in the market later this year. That's all I have for now. Thank you for joining me.